Good evening, everyone, and thank you so much to take time out of your busy schedule on this Wednesday evening to attend our webinar. We are here to discuss UK's latest hotspot, Manchester. My name is Rachel Ho, and I am the Senior Manager of Seville Singapore International Residential Services. Now, if you don't already know, Seville's is listed on the London Stock Exchange. We are a global company spanning over 600 offices worldwide, and we employ over 39,000 people in over 60 countries. Now, one of my dear colleagues here with us today is Jamie Adam, all the way from UK Manchester. He is the Head of Residential Development Sales, and he is here to present on this topic that we are about to share. Do not worry, as we will have a Q&A session at the end. So please feel free to type your questions in the chat box below, and we will answer them at the end of this presentation. Now, Jamie, over to you.
Rachel, thank you very much. And it's a pleasure to be here this evening. And hello to everyone who's joined us. Thank you for taking the time out of, I'm sure, your busy evenings. I'm not going to take too much of your time other than to give you a real overview of the marketplace here in Manchester, what's been happening over the last few years, what the future holds. Firstly, I just wanted to play a very quick video that we've recently put together entitled Wake Up to Manchester. Apologies, a little bit jerky there, but hopefully you got the general picture, some key sort of facts in there talking about what's been happening in the market. Moving on to the slides, which hopefully will come up in a moment. Apologies. There we go. So I wanted to just give you a quick overview of what's been happening in the UK residential market. Clearly some significant factors influencing over the last couple of years, from the global pandemic through now to interest rates starting to rise, inflation running at a fairly high level, alongside many other sort of Western countries, the US and many of the European countries. Obviously, inflation has become quite a factor. You'll see from the chart here, running back to 2020, GDP growth has been running really picked up a very high level in 2022. It's starting to come back a little bit now. You can see the CPI, so there's a consumer prices index, inflation there modeled in green, obviously quite high at the moment. But all of this falls onto a backdrop of really very low unemployment within the UK, pretty much at an all-time record for employment levels. More statistics out yesterday showing that there were more people employed than at any other time in history. So some sort of juxtapositions here in terms of what's happening in the economy. GDP growth has risen slightly, most recently in May. So Some positive signs, some challenges ahead. Obviously, the Bank of England is raising the interest rate, and base rate on mortgages is going up. So that's something that obviously we have to consider, particularly as buy-to-let investors. It's your single biggest cost is mortgage rate. So you can see on this chart, rates are rising. Rates are rising both domestically for owner-occupier buyers, but also rising for investors, be they domestic or overseas. And clearly that has an impact. You can see roughly where these rates sit. This was, I think, a month or so ago, this chart. So in June 20, you can see where the rates sit, bearing in mind the loan to value thresholds. How long that continues for, obviously, is difficult to point out. I suppose the one thing I would say in relation to interest rates is whilst mortgages will become more expensive, clearly the impact of that here in the UK is that there are less people able to purchase a home to live in. And of course, the effect of that tends to be that they rent longer, which obviously has an upside benefit to a buy-to-let investor when there's strong demand in the rental market. It's fair to say that the UK's housing market has performed remarkably well following the global pandemic. You can see the single month, June 20, where there was pretty much flat growth, but pretty much since then, the market has rebounded very, very strongly, particularly if you look at the annualized growth from sort of 2015 through to 2020, relatively flat, relatively speaking, 3.5% to 4.5% growth per year. That has accelerated very significantly from June 20 up onwards, to the point where, you know, we were hitting sort of 14% house price growth during the course of this year. And you can see there, shown in purple, the period of time which was covered by the stamp duty holiday. I think important to point out that regardless of that stamp duty holiday, the market has continued to grow since the stamp duty holiday was brought to an end. So where does this leave Manchester? How does Manchester look from a UK perspective? You can see the two sort of key things that we're showing on this slide. The chart on the left, this plots house prices across the four areas shown on the right hand side, really from January 2005 onwards. So you can see the global financial crisis, 2008 onwards, the impact that had both here in Manchester but across the wider Northwest and England and Wales. But encouragingly, you can see where Manchester now is, which is 40% growth over and above the previous peak in the market in 2008. And that's effectively closer to 55% growth from Q1 2016 onwards. So 55% house price growth since the lowest point in the market, Q1 2016. And Manchester's house prices in the city currently running at 253,000. That's about £120,000 below the average for England. So still, from a cost perspective, from a purchaser's perspective, Manchester offering some pretty good affordability compared to a lot of other cities around the UK. So house price growth has been driven by an imbalance, and that imbalance is, as ever, between demand and supply. It has narrowed slightly, but certainly in the case of Manchester, there is a continued shortage of housing in the city. If you take, for example, the fact that 19,500 properties, mainly apartments, have been built in the city over the course of 2016 onwards, that's a very significant supply coming into the market. That, compared to the fact that today there are only 450 to 500 units available to rent in the city, shows that we've got a very, very significant shortage of supply. all of this against a position of Manchester as a growing city with a growing population, which is expected to hit circa 100,000 residents by 2025, 2026. So we've got a relatively short space of time to find accommodation for a significant growth in our population. And you can see the 2 points where really there was this biggest difference, and clearly that is always around times where we see heightened buyer inquiries and new instructions being limited. So one of the reasons that Manchester's performed as well as it has over the past 2 years, but also really since 2014-15 onwards, has been the effect of growth in other sectors of the economy here in the city and the desirability, therefore, of the city. One of the key sectors that has seen growth and has performed very, very well is the office sector. And yeah, Manchester 10, 15 years ago was seen as a sort of back office city where you would send teams that didn't require positions in London, and that's really changed. We've seen a significant number of large UK and European and international employers choosing to make Manchester their base and choosing to open offices here. And the reason being is that there's an extremely highly qualified graduate workforce in the city, 50% of whom choose to live and stay in Manchester post-qualification. And I think the nature of the qualifications that many of those students are getting in high-tech industry, media, and medical has made Manchester a very appealing place for those big employers to come to. Amazon, you'll see on the screen there, has recently set up a 90,000 square foot office employing 600 people in research and development. So some really interesting employers coming, GCHQ, Booking.com, IT and high-tech related jobs that are coming to Manchester. Clearly the pandemic caused, as it did across the rest of the UK and globally, a waning of demand for grade A and other office space. But it's been remarkable how quickly that market has swung back. And we've now got major employers, both domestic and international, with big mandates here in the city, looking for new space. And I suppose important, alongside a lot of residential delivery coming forward, is that we continue to see offices being constructed. And these are just a few examples of some of the major office and commercial mixed-use schemes that are coming forward in the city at the moment. Circle Square, one of the largest at 1.2 million square foot of grade A. Most of that's now been delivered. Again, New Bailey also in the sort of final phases now. They're on site with, I think, all of the remaining office buildings. And some other big schemes there, Mayfield, 2.3 million square foot of grade A office, all coming forward in the city at the moment. So very encouraging and positive position in terms of commercial take-up as well as residential. Alongside a lot of those, there's obviously been significant changes in the retail sector, but retail in Manchester remains buoyant, new occupiers coming in all the time, and the same also, just a few of the sort of news stories that are coming out of Manchester and have been so far this year. The Times ran a very interesting article back in January asking why it was that everyone under 30 was moving to Manchester. And it is a very, very young city in terms of the profile of resident here. I think it's got the largest population of people under 30, largest concentration of people under 30 of any city in the UK. And that sector is well known as renters, and clearly, you know, as the UK market has shifted residentially over the last decade or so, more and more people are choosing to rent long term, and of course that is having direct impact on performance of different markets across the UK. Manchester's recorded growth in certain parts of the city of upwards of 23.4% of rental growth year on year. This was an article back in July in The Guardian, where it was talking about more than 20% growth in Manchester, alongside growth in London of sort of 11.8% higher than a year ago. Fastest pace of rental growth in 13 years, Manchester Evening News. And then a couple of other stories to pick, just that I've picked out. Economic growth in Manchester was the second highest of 30 major European cities, according to Avison Young in a recent report. And The Economist has once again named Manchester as one of the most livable cities in the world, putting it 28th and above London, and the highest and most livable city in the UK. So in terms of investment in infrastructure, people who are coming to Manchester, businesses are coming to Manchester, and why are they doing that? Well, there's a significant focus on technology through the various universities. You can see a couple of the stats along the bottom there. 52,000 people, I think that figure is probably slightly higher now, employed in technology jobs. And 54,000 people employed in advanced manufacturing. And Manchester is Europe's largest centre for advanced materials research. So there's some really specialist and high-tech learning going on and business happening in and around Manchester and the wider Northwest region. We talk about infrastructure. Of course, one of the largest infrastructure projects that the UK is currently undertaking is High Speed 2, HS2. Recently announced that the leg to Leeds was not going to go ahead, so you'll see the cross on the screen. But Crewe and Manchester confirmed it's going ahead. The final route planning for the route into Manchester currently under review, but government committed to delivering high-speed rail beyond Birmingham and up to Manchester and Crewe, and for the network to continue beyond there. Of course, HS2 will deliver much faster railway journeys to London, dropping the journey time by about 50% from the current 2 hours and 10 minutes down to about an hour and 5. So an important project, alongside other big infrastructure projects and transport projects like the redevelopment of Manchester Airport. If any of you have travelled through the airport historically, you'll know it's perhaps not one of the best. A significant amount of money is being spent on improving that customer journey with new infrastructure in the airport itself. And surrounding that, a very large project called Airport City, which is an £800 million project to develop commercial space and logistics space in and around the airport campus. The airport itself is the third largest in England or in the UK, following Heathrow and Gatwick. It actually handles more global destinations than any other airport, with over 200 destinations in normal times. Clearly, like many other airports around the world and airlines as well, the airport is gearing back up to its pre-pandemic activity levels. I'm sure that will take a little bit more time, but many of the big international airlines are back. Emirates has just announced that they've initiated their third daily A380 flight back out to the Middle East, and obviously Singapore and Cathay now flying back into Manchester as well. And I'm sure in time we will see those schedules back to their normal levels, and equally the number of passengers choosing to travel through Manchester back up and above that 29.4 million that we saw in 2019. It's a major pull for people into the Northwest, and the fact that you can fly internationally and direct to many global cities now is obviously a really important factor for Manchester's performance. One of the big sectors that has seen a resurgence post-pandemic has been the hospitality sector in Manchester, and some really very encouraging and big announcements coming forward about opening of restaurants and hotels in the city. Soho House, some of you may be aware, is one of the largest private members clubs globally. They are due to open an outpost here in Manchester in the spring. Sexy Fish is a sort of infamous and famous Asian-inspired restaurant in Berkeley Square in London, which we believe will shortly be opening. The Ivy, pictured there, 600-seat, 3-restaurant building that opened a couple of years ago. So there's significant interest in Manchester from these occupiers and confidence in the market that they can support these what are effectively quite high-end brands. So I think a confidence from those businesses that Manchester as an economy has the people within the city to support those price points. Manchester continues to benefit from a lot of foreign direct investment into the city. A couple of projects listed there, and a few of the major investors, particularly out of the Far East, but also Abu Dhabi Investment Group from the Middle East as well. I've touched on education. Manchester's one of the largest student populations in Europe. So there's over 100,000 students year on year who come to Manchester for higher education in one of the 4 universities listed on the screen. There's about 18,000 foreign language students within an hour's drive of the city, and there's around 18,000 international students that choose Manchester as the city they want to come to for their education. Many of those from the Far East, an increasing number from the Middle East, and also other destinations globally. A couple of quite interesting stats along the bottom. We talked a minute ago about the sort of high-tech nature of Manchester. Of those 100,000 students, 13,500 of those are life sciences graduates, 15,000 of them are creative or digital and information technology students, and 27% of the UK's material science students are based here in Manchester, the department that first isolated graphene as a material, the world's strongest material. So Manchester really at the forefront of higher education in the UK. Coming on to the mainstream housing forecasts, so these are Savills research forecasts for the UK market. They're expecting growth of about 7.5% across the mainstream market in 2022. Small price falls of circa 1% in 2023, returning to growth for the following 3 years after that. The North and Midlands will continue to outperform London and the South East, and transactions will fall in the South as the market is confined to wealthier buyers. These are the now famous infographics that Savills Research put out. So yet again this year, anticipating circa 10% growth in the Northwest mainstream market, of which Manchester is, of course, the sort of centre. A nominal dip next year, followed by 4%, 4.5%, and 4.5% again in 2026. Cumulatively, therefore, where they're anticipating growth in the Northwest and Manchester of circa 24.3%. So a very positive position, and broadly speaking in line with the growth that we've seen over the last 5-year period. So some really encouraging information there, I think, about the Manchester market, the shortage of properties that there are, the sort of lack of new build stock that's going to be coming through immediately, which is going to help to keep those rents high, but also the growth that we're seeing in the city in terms of population, also going to help to keep that rental market extremely busy. Now, whilst I've got you, I wanted to give you a quick overview of the project which the team in Singapore will be launching weekend after next, which is Victoria Riverside. This is from developers Far East Consortium, FEC, who many of you may know, Hong Kong-based group set up in 1972 with global residential interests running from Australia to the UK, Hong Kong, Malaysia, and in Singapore. And also the group has a hotel brand associated as well. So a global developer one who we've welcomed to Manchester. They set up here about 10 years ago, set up in the UK about 10 years ago, and in Manchester about 5 years ago. They've recently completed their Meadowside project, which is top right on the screen here, these two buildings, and Mount View, which is another development on the left-hand side here. They're on site with a further development in New Cross, which is coming to a completion. And the next project that they're launching is Victoria Riverside. Now, that sits within a very major urban regeneration project called Victoria North. Victoria North is a joint venture between Manchester City Council and FEC. The intention for this master plan is to bring forward around 15,000 new properties over the course of the next 15 to 20 years. So to summarise Victoria North, I mean, really one of the most exciting projects outside of the southeast of England at the moment, certainly the biggest. You'll see on the picture to the left, this is a satellite view of Manchester with the city centre effectively ringed by the white line. And you can see how large in comparison the Victoria North project actually is. So as I say, this is a 15,000 property project with an investment of over £1 billion, covering an area of 155 hectares. So really a very, very significant project. FEC and, as I say, Manchester City Council doing this as a joint venture. And one of the key benefits of this is going to be bringing forward new parks and new transport links to this part of the city. The first phase of this development, Red Bank, will involve the creation of a new city park covering about 46 hectares of land, and this will be finished in line with the completion of Victoria Riverside, which we'll come on to in a moment. As I say, one of the largest new parks created, certainly in Manchester, probably in the north of England in recent times, and a really nice backdrop for these new developments that are going to surround it. You can see here just where this sits in relation to the rest of the city centre. So you've got the city centre here, Victoria Riverside, the scheme we're going to talk about, and then this new City River Park shown in green here alongside the River Irk. So Victoria Riverside, this is, if you like, first spade in the ground on this major regeneration project, a master plan, this 20-year project. The scheme Victoria Riverside is 634 properties in total, predominantly apartments with some townhouses. And we are very pleased, Savills are delighted to be launching the building on the right-hand side, Crown View, which is the sort of premium tower within this development, and on the city centre side of the development. So enjoying some fantastic views over the city, but also back over the City River Park. You'll note quite unusual design, but designed in such a way that each of the apartments has got one of these very large picture windows with some fantastic views over the surrounding area. Key facts about Crown View then, so the architects are Hawkins Brown, 275 properties in total, all apartments across 36 floors with a range of 1, 2 and 3 bedroom properties. As I've just said, each of the properties gets one of these picture frame windows, and you can see a CGI of that with the city centre view. A really fantastic feature to have these big windows. And some incredible views. Luxury residence amenities, which I'll show you some pictures of shortly. I don't intend to go through the detail of the specification, but obviously, should you be interested and want to attend or want some more information, Rachel and her team would be delighted to help you. Suffice it to say, this is a very high level of specification in line with all of the leading schemes being delivered in Manchester at the moment. Just a few other CGIs here to give you a bit of an idea, but as I say, a really nice high quality specification and a look and feel. I think some of the communal areas in this development, what really stands out to me. So these are just a few images from the development, which I'll flick through now. So this is the concierge lobby here. Again, concierge lobby looking back from the other way. So this is at ground level as you come into the building. This is the residence lounge. So this will be obviously fully set up. And if any of you are aware of the projects that FEC have delivered so far, Meadowside's got a version of this, again, finished to a really high standard. So there'll be a bar area as well, which I understand will be available for private hire by the residents. A fully kitted out high-tech gym. That's got some fantastic views over the new City River Park as well. And then there'll be a private podium, which will be private to this tower only. As you can see there, we've got an aerial view of it and a ground level view, but a really nice environment for residents externally from the buildings. And again, you can see these great big picture windows on the corners of the building here, which are differentiated by different colour. So something quite interesting, something a bit different. You know, we've seen a lot of high-rise buildings come forward in Manchester with a fairly monolithic design pattern. I think something really different here, architecturally interesting and stand out. So that brings to an end the presentation. Be delighted to take any questions that anybody's got. And Rachel, I know you're going to take over from here. So thank you for listening to me. I hope I didn't go on for too long.
Thank you very much, Jamie. That was really very insightful. Now I'm sure the audience have some questions for us. But before we move on to that, as you can see here, we've got some QR codes. Please feel free to scan the QR codes and like our Seville Singapore Facebook as well as LinkedIn page. Our contact details are there as well. And as promised, I've already pinned down the in the chat box below the details of our property exhibition of Victoria Riverside. It's going to happen next weekend on the 24th to 25th of September in the Marriott Tang Plaza Hotel. So do reach out to us and let us know if you would like to come by, and we hope to see you there. So Jamie, for our first question of the day, we have one from Mr. Lee. He asked, do you believe the city centre living in Manchester has reached saturation point? And if not, why so?
Very good question. I think we're in danger of reaching a point where we haven't got enough properties for tenants to live in. I did a search on Rightmove over the weekend just to see what the live number of units available was, and I looked for apartments within the city centre, and at the time it showed 463. Now, for a city the size of Manchester, with an employment number of employees that Manchester employs, that's clearly nowhere near enough properties. I think also we've got to take into account that, you know, the city council themselves firmly believe that the population in the city centre is going to continue to grow. I see it every day. I work in Manchester daily. The number of people here really has grown significantly. So I think that there is significantly more new housing required, be that for owner occupiers, be that for landlords to buy, because the market really at the moment is short on property, hence why we've seen such high increases in rents across the city over the last 6 to 12 months.
Very interesting. We have got another question here from Madam Lee. So she asked, how do you feel about the raising bank mortgage interest rates? I think this is what a lot of us are concerned here at the moment, because people are talking about a recession and things like that. So how has this rising bank interest rates have affected the UK property market, and more so in Manchester?
I mean, in terms of the impact that we've seen from the rate rises that we've had to date, very hard to say that there's been any direct impact. We've just come off the back of our best 3 months of trading and sales ever in Manchester, with over 60 property sales agreed. I think I touched on this in the presentation. You know, clearly nobody wants interest rates to rise. We've all become very used to interest rates being at historically low levels for quite a prolonged period of time. And I think we're far away from returning back to the sorts of interest rate levels that some of us older people might remember in the 80s and 90s. We're probably more likely to return to the levels that we remember seeing in the early 2000s, where interest rates are at sort of 4 or 5%. And of course, you know, there's a benefit if you're a saver to there being some decent interest rates. The other thing I think to say, as I touched on in the presentation, is with interest rates rising, the number of people who are able to purchase and you know, their affordability allows them to purchase will be reduced, particularly in that younger demographic of people. I think also worth remembering that the government here in the UK have now brought to an end, or will very shortly be bringing to an end, the Help to Buy scheme. So there will be more and more young people who, either through choice or otherwise, end up having to rent for longer. And so whilst buy-to-let investors clearly will see their interest rates rise, the sort of flip side of that is that there are going to be many more people in the market wanting to rent. And so there's a potential for some offset from the interest rate rises being offset by the fact that the cost of renting and their rent receipt is going to be higher than it would otherwise have been.
Okay, I think it's interesting also that you brought up the Help to Buy by the government. So for those, you know, the local investors here who are not so savvy in the UK property investment scene and do not know what is Help to Buy, can you share a little bit about that?
So Help to Buy was a scheme that was introduced by, I think, 2 or 3 Conservative governments ago, following the global financial crisis. And it was a scheme that effectively the government would underwrite 20% of the equity on a purchase, which would mean that the buyer, in theory, a first-time buyer, would only need to find a 5% deposit to buy a new build property, and the government would effectively back 20%. And then the mortgage company would need to come in and do a 75% mortgage. That scheme now is coming to an end. The final units that can be funded through that route are being sold as we speak, and I think October is the sort of next cut-off point. So really, we're moving to a situation where the UK mortgage market doesn't have that sort of government underwrite in it for new build. Some say it was unfair, some say that many people who, you know, arguably didn't really need it benefited from the scheme. So it's a bit more of a level playing field going forward, and partly that's because frankly the new build housing market has been performing exceptionally well over the last couple of years. Okay, great. So this will help for our investors as well. So more people who are unable to afford to purchase a property because there's no such scheme in the near future would have to be forced to rent, right? That's all right. I have another question here. What would be the exit strategy for a 1-bedroom property if the focus is largely on rental? As in, how long should somebody keep that property, or what? Yeah. I mean, I think for most investors, I mean, we've seen, frankly, very few investors exit their investments in Manchester over the last few years. And funnily enough, an exercise I've asked our rental team here to do is to look at some of the properties that we sold to investors 3 or 4 years ago, and to I've dug out what we said those investors were going to be able to rent those properties for 3 or 4 years ago. And what's been very interesting, and actually exactly what I thought was going to be the case, is those properties that we sold to investors, some in Singapore, for example, they haven't sold those investments, they've retained those investments. And part of the reason that they have is that they've had virtually 0 days not being occupied and not receiving their rent, and the rent is now in some cases 20-25% higher than we said it was going to be. So actually, there really hasn't been there hasn't been a desire from most of the investors to sell their properties. Should you want to, then there is a ready-made market of owner-occupiers who would buy, and of course, second-time investors who don't necessarily buy new, but are looking in the second-hand market. So I don't think I've got any concerns over there being an exit for these properties, either relatively soon after completion or in 4 or 5 years' time. But most of our clients have chosen, because of the performance of the market, to keep hold of these assets.
But generally, I think you and me both, we will always advise our buyers, to be able to retain the property and have like a sort of a longer runway of holding period of maybe 5 years, 3 to 5 years. And
Yes.
if you want to exit the market, then you can do so. But like what Jamie mentioned, because the rental yields are so good, they have 0 void days. So most of the investors that you've experienced actually retain their properties even after those number of years, right?
That's right, Rachel.
Okay. Great. So what are the current sentiments or policy towards international buyers buying property in Manchester? Is there a quota for international buyers versus local?
There's no government quota. There's no local government quota as to who can buy these properties. Clearly, developers will decide themselves how many buyers they feel comfortable selling to in certain sectors. What we have seen is a resurgent owner-occupier market, much more so than we've had at any point really since 2016. And that's partly been driven by relocations, people relocating from around the UK, predominantly, I have to say, the southeast and London, into Manchester, coming with healthy budgets. So there has been a shift. If you'd asked me that question 4 years ago, a high proportion of the units that were being sold in Manchester were being sold to investors, be they domestic or international. Now, I'm not suggesting that the international demand has waned. It hasn't, but there are more domestic owner-occupier buyers who are also looking to buy in the city centre. So it's a bit more of an even platform.
And I think to add on to that as well, with every scheme that the developer has to roll out, in order to give the local residents some supply as well, there is some sort of percentage going on to social housing, right? So then you have got the private market and the social housing where only local buyers can buy. So that is one way for them to mitigate, how many foreign investors can purchase into a scheme, because a certain percentage of it is only open to the local buyers. And apart from that, I think it's also interesting to add on that you as an international investor, there is no limitation on how many units you can buy. As long as you are capable to do so, you can buy as many as you want. But of course, with regards to the stamp duty, the only difference between you and the local buyer is that you have to pay an extra 2% in the stamp duty. So I hope that clears that up. We have got 2 more questions that we can talk through. So one of the attendees was asking, would you advocate an interest-only mortgage for investment?
If you can get one, then yes, definitely. Yes, I look for buy-to-let purposes. There seems to me very little point in trying to pay down the capital. You're investing on the basis of 2 different things. And this is where, this is, for example, what differentiates, say, Manchester or Birmingham or Leeds or the regional cities with, say, London, is that we offer both a yield return, i.e. a month-on-month return, positive return, as well as capital appreciation opportunities. And so because of the price point in London and the purchase costs and so on in London, your yield is very, very low as a gross figure. And actually, by the time you've netted out all of your costs, it's probably, in a lot of cases, washing its face It's, you know, you're earning off it what it's costing you. Whereas in more the regional markets, and particularly Manchester, because the cost of purchase is lower, but the rents aren't proportionally the same amount less, you end up with a yield. The average in the city centre at the moment is about 5.4% gross. Some of the schemes are kicking out 6.5%. So you not only have that, but you also have obviously house price growth coming off a lower base. And as I indicated in that video showed, Manchester's about £120,000 less than the England average for a property. So there's good affordability. There's also good growth opportunity within the city. So I think, you know, most of our investors are looking at it from both a capital appreciation perspective, but also from a yield perspective.
That's great. And I think to jump in on this interest on the mortgages, because this scheme is in Manchester and we're talking about purchasing in Manchester, local banks here in Singapore, they only loan to properties that are located in London Zone 1 and maybe Zone 2. The only bank that we know of that will loan in Manchester is Maybank. So that also reduces your options. So if you were to get a loan from a UK bank instead, that's where you can explore, you know, getting your mortgage loan as an interest only. This will definitely help in terms of your cash flow. And if you're an investor, I think that's the way to go. So one last question from us, and then we could wrap up this webinar. The pound seems to be on a downward trajectory. What are the risks there in investing in UK property?
So the pound has reduced, and I was just looking for a figure. I think I've written it down somewhere. I think the pound is currently trading at about 12.5% to the Singapore dollar, lower than it was about 12 months ago. So yeah, in a sense, immediately, you're already 12.5% better off than you would have been if you bought a year ago. So look, currency play, there's always pros and cons to it, because of course we've had house price inflation in the meantime, and so actually you have a discount to the pound of 12.5% compared to a year ago. The market's gone up probably 12 to 14%, but actually in effect, because of that currency differential, really your actual cost is 2% more today than it would have been 12 months ago. In terms of the long-term outlook, you know, there are some major challenges in the global economy in terms of fuel prices and consumer inflation, which, you know, a lot of countries are seeing at the moment, and you know, much of that derived very sadly from the conflict in Ukraine and the impact that that's having on energy flows and the raw material price, but also, yeah, for a lot of us, it's still part of the COVID recovery, if you like, the global supply chains that we've all became so used to, with product from China and from the rest of Asia, you know, harder to get hold of, and so all of that's impacted. So yeah, I think, you know, I think from a currency perspective, the pound probably continues to weaken over the next 6 to 12 months. Probably not dramatically, but there may well be some benefits, some currency benefits to a purchase at this point in time.
So thank you so much, Jamie, for your time, and thank you for everyone for your time to attend this webinar. We've come to the end, and just a reminder that we have our property exhibition for Manchester, this scheme called Victoria Riverside at Marriott Tanks Plaza Hotel on the 24th and 25th of September. Thank you very much again, everyone, and have a great evening. Goodbye.
Thank you.